Hello, everyone, and welcome to OC Live, a weekly broadcast on blockchain, branded tokens, and token economies. We feature weekly guests to discuss the latest in blockchain and the current projects that they are working on. And with us today, we have Zachary McClure. He also goes by Zach, and he is the co-founder of TokenTax. And on this episode, we're going to be discussing best practices for U.S. taxpayers, and we're going to provide, or Zach is going to provide, a global perspective on crypto tax regulation. But before we get started, Zach, welcome to OC Live.
Thank you so much for having me, Jose. I'm excited to be here, excited to talk about crypto taxes, and hopefully give all of your listeners and watchers something useful going into this tax season, wherever they are in the world.
Yeah, so, hope to provide you guys with information. If you have any questions, for those of you that are watching this live, feel free to type those in the chat. And once we get towards the end, I'll jump into the chat. And if we have time, we'll go through your questions. But just as a side note, before we go further, this episode is not to be taken as any financial advice. We're just having a one-on-one conversation, an interview to provide information on crypto tax regulation in the U.S. and what Zach knows about what's going on in the world in regards to crypto taxes. But before we jump into the tax questions, Zach, can you tell us a little bit about your background and your work as a CPA?
Yeah, so I've had a pretty eclectic work background. I graduated with a degree in accounting, degree in finance, and then went and didn't go straight into accounting. I went into investment banking, spent a couple years doing that. And then I went and I got involved with a program where financial professionals were teaching financial literacy to inner city high school kids and talking about compounding interest and checking accounts and how to have credit responsibly and things all of us should know. And so basically I got into teaching for a couple hours a week and absolutely loved it and just decided, all right, I'm going to take a break from the corporate world. And I went and did Teach for America here in New York City. And I ended up teaching math to high school and middle school students and, infusing it with entrepreneurship, personal finance, the stock market game, taxes, just helping people understand. And not just the students I had, but even teachers and other people in the building would come by. And, you realize, wow, even financial professionals don't know that much about this stuff, and it's enormously valuable. And understanding financial literacy adds 20-30% to your lifestyle, to your earnings. And then from there, I kind of arced back to the business world when I worked at Bain, Imprint Capital, worked in impact investing on the VC side, and also spent some time working in Africa and India during my summers off. So doing corporate structuring, legal structuring, basically helping nonprofits over there become social enterprises and become self-sustaining and not dependent on donations. So kind of my hope for the new form of capitalism where companies not only do good, but also make money so that they're self-sustaining. And, from living in Zimbabwe, from working in impact investing, I started to learn about cryptocurrency and wanted to get involved, was an investor, was going to meetups in New York. And, at a Crypto NYC meetup, I met my current co-founder, Alex, who was working on a platform to basically help people file their crypto taxes. But it was just for connecting to Coinbase. And, it didn't have a lot of the functionality of TokenTax. And I was like, Alex, we could do this much bigger. We could teach people about specific shares accounting. It'll make a huge difference in their taxes. We could teach people about tax loss harvesting, and we could basically democratize access to this knowledge that only people who have private wealth managers or private accountants managing their family office or really wealthy people have. And we can kind of just teach people in the crypto community for a much lower price. And so that's how TokenTax was born back in 2017. And so now we're getting ready for our second tax season.
Great, and congratulations for that. So how long ago did you get your CPA?
I don't have my CPA.
Oh.
I worked in finance and accounting, and I probably just know more about random crypto tax stuff than anyone ever wanted to know or expected to know. But yeah, I never sat the exam basically. So it's a 4-part exam that I would have to sit in the state of Colorado, but I have all the other requirements to be a CPA. but I don't personally file taxes. I have CPAs on my team who file taxes.
Great. So, how big? You before the call, you were telling me about the team was growing, and especially with this tax season, you guys are looking to get a bigger space. So, how big is your team currently?
Yeah, we're 10 people right now in New York, and we also have a couple engineers in LA. Shout out to them who have been doing a great job building all of our infrastructure, like our pricing databases, our exchange tools, things that we're actually looking to sell or, let other startups use as a way to avoid reinventing the wheel. We built connections to 40 or 50 exchanges via API, plus we support all these other exchanges via CSV, like that transaction record in Excel that you can drag and drop into our system. And, that was a huge amount of engineering work, and we'd love to help other startups get a leg up and not have to do the same thing. But we're about half crypto and crypto tax accountants and half engineers here in New York.
Great, and we'll get into a little bit of that towards the end in regards to how to track transactions. But let's get started with the crypto landscape. Can you provide us a little bit about, or tell us a little bit about the global landscape on cryptocurrency, or maybe do you think we should leave this question to the end?
No, I'll give a quick overview. So, there was a big G8 meeting down in Argentina, and a lot of the major players from different countries are talking about cryptocurrency as a security, which is which is like what a stock is, like Tesla stock, McDonald's stock, Google bonds. Well, they don't have bonds, but Apple bonds. So securities have special taxation rules in the US and special registration rules, which is why all these ICOs were problematic, the initial coin offerings, because basically from the SEC's, the Security and Exchange Commission's perspective, they were unregistered security offerings. And so that's kind of the lens that we are viewing cryptocurrency tax through, because unfortunately the IRS hasn't really given any guidance until like in 2014. They said, oh, it's not a currency, as in it's not like the euro or the dollar. It's property. You have to pay tax on it. And every single event when you sell it has to be reported. Even if you just bought coffee for $4, you need to report that. And that's pretty much the last thing they said, other than pay your crypto taxes. Yes, crypto to crypto is taxable and all events have to be reported. But they haven't said anything about, here's how you should treat a fork. Here's whatever accounting method. Here's how airdrops should be treated. So a lot of what we have to do is take the rules we know for property and for securities and use common sense and be conservative, be consistent, just follow all of the maxims in accounting and what the IRS expects from everyone. But basically, we're kind of writing our rules, writing them publicly and saying, hey, here's an article on CoinDesk, an open letter to the IRS or the AICPA. A group of accountants are submitting rules and ideas to the IRS, but none of them have been formally adopted. And once that happens, I think you'll see a much easier process for accountants to get onboarded. Right now, it's so difficult because there isn't like one set of rules you can memorize for accountants. They kind of just have to use their best judgment, and not every situation is the same. So you have like delayed purchase tokens, you have airdrops, you have SAFs, you have people getting scammed like BitGrail, but then you also have people losing access to their wallet. Now you have Quadriga. People had crypto at Quadriga exchange in Canada, and now that went bankrupt, or that, their founder unfortunately passed away. And he apparently had the only code to $190 million worth of crypto. And you see stuff like that, and it's like, what's the tax treatment? That's how we're thinking about a lot of these things. And there isn't necessarily one exact answer, which makes this so difficult. And then, you see the UK, they just had their tax season end on January 31st. They have an April 6th to April 5th year, which is interesting. They have average cost accounting, which is very different than what's allowed in the US. They have a lot of special rules, but they actually came out their version of the IRS, the HMRC, came out with many pages of rules and guidance about how crypto should be taxed. So that was super helpful, but that's one country. And we would love to see the IRS follow suit and give more guidance there. But right now we have customers all over the world, and luckily calculating gains and losses is very similar. And then in each country, it's kind of which accounting method is allowed, what are the tax rates, is there long-term and short-term. And so we're doing it country by country basis, and we basically have an encyclopedia of capital gains and losses by country, or mining income taxation by country. But the bottom line is that it's pretty much different in every country. The calculations are similar, thankfully, but the exact way of filing and what has to be filed is different from country to country.
Great, and we'll try to get through as many of those taxable events as we can on this episode. I don't think we have time for all of them because there are quite a bit. But I guess we'll keep other countries in mind when going through this. Is the UK?
Yeah, where are most of the listeners from?
I don't have the geographical data right now, but it's pretty global. I'd say maybe half from European countries, and then a good chunk from the US.
Yeah.
So I'd say the base majority, maybe like let's throw in a number. I think maybe 30% US, but gotta follow up on that.
Okay, yeah, that's super helpful. I mean, even in Europe, every country is different. You know, Germany has, if you're over a year, you pay no taxes. Spain requires FIFO. So, you know, if you're from a country where we don't mention, you could always just come to the website, TokenTax.co, and ask us questions via intercom on the bottom right. My team and I are always there to chat and explain whatever, and we'll send you the info we have about your country, because I know it's going to be really tough to hit 8 countries in a 1-hour show, let alone one.
Definitely. So we'll keep sort of the US in mind for this episode, and if you guys would like to focus on another country, maybe we can follow up then. But let's start off with debunking some of the common myths or misconceptions about crypto taxes. The first one being, is there a minimal capital gains or loss that one must incur before they are required to report?
Yeah, great question. So in the US, no, there's no minimum. Even if you lost $1 million and every single trade you made, you lost money on, you have to report it. Even if you only bought Bitcoin and then spent it one time to buy a coffee or to pay someone online for some subscription or whatever, you have to report that technically. And you report it as a sale, and you have to report the cost basis. So when you bought it, how much you paid for it, and the gain or loss on that sale. And that's what makes this so difficult. You have to report it in US dollar terms. And then, you know, just to compare, in the UK, if you have under 11,300 in gains, you don't have to report anything. It's honestly a much better system. Yeah, it would be bad for business for us, but that's totally fine. I would much rather have it so that way fewer people have to file tax returns. Over in the UK, if you work for a company the same way like in the US when you get a W-2, your company actually files your tax return for you. So most people in the UK haven't actually ever filed a tax return unless they're self-employed, which is just awesome. And it's a model the US should look at. The more we look at other systems in other countries, I realize it's insane how many people in the US have to file, even though they have such a simple situation. And even crypto being a lot more complicated than just a W-2. If we had a minimum threshold, as you said, way fewer people would have to file, and this would be a lot less of a burden. But unfortunately, no, in the US, everyone has to file, whether you lost money, had only one transaction, whatever.
And it may definitely seem overwhelming. So for those of you that did get involved with crypto, just push through this and abide the law, because you don't want the worst case scenario from the IRS. But what are some of the top most common mistakes that people make in regards to cryptocurrency and taxes?
Yeah, I think we made a list of a few, but number one is they don't keep good records, and so this just makes life so much harder when you traded on 5 exchanges, you kind of did an okay job, and you kept all the records for 4 exchanges, and then you just didn't record anything for your shapeshift trades. And then it's kind of like, all right, well, you're missing an entire gap of data. So what we have to do is go and create synthetic trades, be conservative, and say, all right, we look at your closing balances. You've got 18 Bitcoin according to our system, but we know you actually only have 14, and and you have 7 ETH less than you should. And so we have to make these synthetic trades, and we know it happened in this 6-month period, but then we have to find the lowest price. And it's a very manual process, and you're going to end up paying a lot of money to an accountant or spending a ton of time yourself filling in this missing data or reporting incorrectly or whatever. And so, please keep good records. A lot of us probably saw what happened with Liqui and then Quadriga, which is a tragedy. And so Liqui is gone now, and they basically disappear. Even if you go to their website, there's nothing there. So if you didn't get your data from them, you could just be out of luck now. And so, a lot of the TokenTax customers put API keys so that all their data, all their transactions are automatically pulled through. So luckily, when Liqui and Quadriga made these announcements, we were able to pull all the data for everyone who had API keys in our system. And so that's just another reason to have good hygiene. Use a tracking tool. By the end of this week, we're going to have free, where you can create a free account and actually import your data and just use it to store your data for situations like this, because we feel really bad, and it's going to make everyone's life harder now that no one is able to get their Quadriga and Liqui data. And so keep good records. That's number one. Number two is not realizing that crypto to crypto trades are taxable events. If a lot of people tell me, oh, I never sold crypto. I've only, bought Bitcoin and Ethereum on Coinbase, and then I bought a bunch of altcoins on Binance. Well, how did you buy those altcoins on Binance, right? You had to use other crypto to buy them. So that counts as both a sale of Bitcoin or Ethereum or whatever, and a buy of an altcoin. And so a lot of people, maybe that's a little bit mind bending for them, because they don't think of it as, oh, I sold Bitcoin for the altcoin. They just think, oh, I bought altcoins, I never sold them. And that's not how it works. Crypto to crypto counts as a sale, unfortunately. A lot of people from Coinbase, from Gemini, from a lot of other US exchanges are getting 1099s yesterday or earlier this week. And what's happening is Coinbase basically said a lot of the withdrawals are taxable events, and some of the other crypto tax platforms as well. And that's not actually the case unless you are selling it or using to pay for something. And that's why a lot of people are overpaying their taxes who use the Coinbase tax reports. And what happens is they come to our site, and then we help them. All right, these withdrawals from your Coinbase account to your Binance are actually not taxable events, but you need to make sure you report all your Binance events, all your Binance trades, because someday when the IRS comes and says, hey, Coinbase told us that you had this other sale, and then you say, oh no, I transferred it to my Binance, that wasn't a sale, Coinbase was incorrect, and you explain to the IRS, they're going to say, all right, well, show us what happened to those trades. And then you're going to be like, oh yeah, all my Binance trades are right here down the 8949, which is the gain loss report you have to file in the US, which I saw was the next question coming up.
Good. Yeah. That's that's another question: is which forms do people report gains and losses? Another would be income if it were crypto. But I guess let's get into. Well, let me backtrack. You mentioned tracking crypto. That's sort of a question I had for the end, but I guess we'll go over that now. So I guess the standard way that an individual would go about tracking their trades or their buys and sells would be to go on the exchanges that they use and download the CSV files or and open them up in Excel and try to sort them through in sort of chronological order and track where each trade went, whether it went from inside and outside an exchange. So what are some tools that people can use or some methods that people can use to make this a much smoother process?
Yeah, you're exactly right. You need to there's no standardized format for one. Every exchange has their own type of CSV, and some of them call it, like Kraken, they call it a ledgers report. So everyone's like, wait, I have 244 ledgers. Why when I import it is only 140 trades or whatever? And it's like, oh, well, not every ledger is a trade, but it's also not 2-to-1, sometimes 3-to-1, whatever. Basically, there's no standardization across the industry. So you need a tool like TokenTax, where what we do, we have step-by-step instructions for every single exchange out there. And if you're on some really obscure exchange, just give us the CSV or whatever output, and we'll have our engineers add it so that it's automatically supported in the future. But for now, you can put it into our manual template, or someone on my team can help you. That's the difference of TokenTax. Is like we have accountants and crypto tax experts who used to work with me at Bain and at JP Morgan, who are Excel wizards and can fix any data formatting and have the formulas and the templates to do that, to get it all into one format and keep it in one tracking software system. And once you have it like that, then your life is already exponentially easier, because this is what we were doing before TokenTax. You have all these different formats. You basically need to be an Excel wizard and an accountant in order just to get your data into one of these systems correctly, and then to make sure that you're actually creating the right gain loss report, that it's actually compliant, that they're using US dollar spot prices the same way. There wasn't a single system out there for doing this for my own taxes or for people who were asking me for help. And that's why when I met Alex, I was like, let's do this the right way. Let's build on top of the shoulders of giants and not reinvent the wheel from a tracking tool or whatever, but just make really good tax reports and have people checking your work. But at the end of the day, the best tools out there, if you're trying to do this on your own, are Excel. And, at least you have a copy on your computer. But I really recommend using something like TokenTax. And now we're going to have a free version for just keeping your trades somewhere so that you always have them in your back pocket, whether an exchange disappears or whatever happens. Mt. Gox, for example, we have many, many clients who bought crypto at Mt. Gox and didn't track it. So when they go to sell it in 2017, 2018, there's all these missing cost basis. And, we have to help them recreate that data. So just get in the habit of saving all your crypto data somewhere. And in the future, you'll be able to just hand it all over to someone like us. We can figure it out for you and get your taxes in order for however long back that you need to file.
Great. Yeah. So the most important part before filing is to keep track of your crypto data and make sure you have that data, whether you keep track of it manually or you use a third party service.
And well, can I just say, and you don't need to keep track of everything in Excel yourself. If you're trading on an exchange, the exchange should keep it somehow. Just get the data from the exchange. What you really need to keep track of for yourself is if you do these ICOs or, initial coin offering, if you were sending Ethereum in an over-the-counter trade and getting whatever other altcoin back, keep track of that. Just keep track, oh, I sent 9 Ethereum and I got, 10,000 0x or whatever it is. Or the same for these SAFs, these like future tokens that you'll receive potentially in 2019, 2020. Those aren't tracked at exchanges. So you don't need to keep a copy of all your Coinbase and Gemini trades. You just need to make sure you download the CSVs from those exchanges. And the thing is, who knows which exchange will disappear tomorrow? And so that's why it's good to keep your records as up to date as possible, as fortunate as it is.
Definitely, most of these exchanges will provide you with your trade history. And I think an important concept before we get into the U.S. Taxable events to understand sort of the basics is cost basis. So can you sort of explain the 101 of cost basis and maybe some accounting methods of like LIFO or FIFO?
Yeah, exactly. So, happy to. So basically, cost basis is how much you paid for that crypto. So let's say in a really simple world, in 2017, you bought one Bitcoin for $1,000 in January 2017, and then another one for $10,000 in November 2017. And then in December, you went and sold one Bitcoin. So both of those Bitcoin are in the same wallet. You sell one, and if you use, and let's say you sold it for $15,000. We all know the price spiked in December 2017. This happened to a lot of people. They sold one. Now, most accountants out there, people doing it in Excel, they would do things using FIFO, where, all right, we sold the first. So that's first in, first out. So the first Bitcoin you bought is the first one you sell. So as you can see in this example, $15,000 of proceeds minus 1,000 cost basis means your gain is 14,000. That's what you pay taxes on. Whereas if you use LIFO, last in, first out, then your gain is 15,000 minus 10,000. Your gain is only 5,000. You can see it's dramatically lower. And so FIFO, LIFO, and then we have something called minimization. And again, this is how I trade my own stocks in real time. When I sell Google shares, and how every hedge fund and every savvy investor should be trading. When you sell your Google shares, you get to see the tax lots that you've bought. Say you've been buying it quarterly, you've been reinvesting your dividends. So you've bought more Google shares every quarter for the past 10 years, whatever it is. When you go to sell some of them, you pick the ones you want to sell, and you could pick the ones with the highest cost base. What I do is I pick the ones that minimize taxes. So I don't necessarily pick the ones I just bought. I'll see, all right, I've had those for over a year. So the long-term capital gain rate comes into play. Let's say it's 15% instead of 30 or 40% for short-term capital gain. But I do the math and I say, all right, selling which Google shares are going to minimize my taxes and go down the list when I'm selling. And so we have that algorithm at TokenTax for crypto. And basically the idea is people are tracking their own tax lots. They know they're doing it, but the exchanges right now don't have the functionality to let you pick the tax lots in some cases. And so in our system, you can actually see in real time, all right, if I sell these tax lots, this is what my tax liability will be. And so in other words, all of these are just variations of specific shares accounting, FIFO, LIFO, minimization. All of these are tracking the tax lots and selling a specific one. That's like one category of accounting, one category of cost basis. On the other side, you have average cost, which is what's required in Canada, in the UK, in some other countries, and isn't really allowed in the US. If you can track at the tax lot level, it's only for things that are untrackable at the tax lot level, basically. And so a lot of people filed average cost in the past, and then maybe they have to figure out, all right, should I amend or whatever? Or back then I wasn't able to track tax lots. I only knew I bought 20 Bitcoin and I spent, $2,000, and that's all I knew. And you know what, if that's the case, it is what it is. But now with tracking software, you absolutely should know all your cost basis, all your tax lots, and you should use an accounting method like FIFO, whatever. And what minimization does, it takes into account your long-term capital gain rate, your short-term capital gain rate. So we know you have to tell us what your estimated income is, where you file, your filing status. From that, we know your exact long-term and short-term capital gains rates. And we can say, all right, does Jose in California prefer $1,000 long-term gain or a $500 short-term gain? Before you make the trade, you can actually see this. And the answer is different if you lived in Texas, probably, where in California, they have a really high long-term capital gain rate on people making over $1 million, which I'm sure you do, Jose. No, I'm just kidding. But, it's different in every state. And that's why this is so interesting and so difficult. You probably see there's like 100 crypto tax platforms out there, but no one else has this because it's not as straightforward and as easy as people think it is to create this. A lot of talented software engineers are like, oh, I could make a better system for filing my crypto taxes. But there's a lot of accounting that goes into this. It's not just being a great software engineer. And that's kind of, what's different about us. But, if people have more questions about cost basis, it's incredibly complicated at that once you have a lot of trades. So please come talk to us about it. I can't do it justice in 2 minutes, but basically, in a nutshell, there you go.
Yeah, I think one of the, you mentioned the tools that are available in with regular stocks. I think one of the things that makes it difficult about cryptocurrencies is that they are fractionable. So you're not just keeping track of one to one. You have to keep track of decimals of different types of cryptocurrencies. And I think that's
exactly. And you're trading crypto to crypto. So people might know the price in Satoshis. They have no clue the price in dollars. A lot of times people lost money in Bitcoin but made money in dollars. And it's sort of mind-bending, but that's what happens when you have a third conversion that has to happen in the background. And stocks, you also trade fractional stocks. Like if you have a retirement account, and quick PSA for all the listeners, put money in a retirement account, buying stocks, buying other investments, having a diversified portfolio, not just crypto, is extremely smart. And, you can just have it reinvest. So you buy, people say, oh, I'll never be able to buy a share of Google. It's $1,000 each. Well, no, you can buy 1/10 of a share of Google, just like Bitcoin. This is another very common misconception about crypto and stocks, is that you have to buy an entire one. And you're exactly right. You don't. You can buy a fraction of any of them, just so you know.
great. And let's jump into these taxable events in the U.S. I'm sure we can knock out the first couple of them since we already talked about it. So selling crypto for fiat, selling crypto for fiat. I think that's one of the most simplest taxable events out there. So if you sell your crypto for fiat, then that is the most basic taxable event. And then
I'm sorry, go ahead.
And then I was just gonna move on to the next one, which is trading for crypto. But we're gonna add on to that.
Oh, I was just gonna run through them really quick. I mean, selling crypto for fiat I'm happy to run through them or let you run through it.
Yeah,
But yeah, trading crypto
definitely.
to crypto. Crypto to crypto is obviously a taxable event. If you buy goods or services with crypto, like we said, coffee, if you pay for a meal, a lot of people bought a subscription online, or they bought a video game, or bought something on Overstock. That's all of those are taxable events. Selling goods and services for crypto. And so those first three are taxable events and have to be reported on an 8949, a gain loss report, which, and sorry for the technical accounting, but just to give you a run, and those flow up to a Schedule D. And then other important crypto forms are like this one, selling goods or services for crypto. So selling goods or services for crypto, in other words, you're getting paid in crypto for stuff you're selling or for your time. Like you're working and your salary is getting paid in crypto. Now that's like mining. That you're getting paid income. And so that would be like self-employment income on a Schedule C. You might have expenses to offset against it, but it's a different tax form. And what's interesting about that is, let's say you got paid Bitcoin, you got paid $10,000 a month in Bitcoin, you received it, and then so that is all reportable on a Schedule C as income. And then like self-employment income, let's say, if you're a contractor and someone hired you to work on their website, whatever. And then when you go to sell that Bitcoin, the income you reported is the cost basis, going back to this topic earlier. And the proceeds are what you get when you sell it. So you could actually have a loss if you receive 10,000 of crypto for January and went and sold it first week of February for 9,000. Well, you have income of 10,000 and then you have a capital loss of 1,000. So it's like two separate parts of the tax return, just so you understand. And that's how mining works. All right. So going down the list, yeah, mining is the clearest of this. So if you receive it, that's like self-employment income. And then when you sell it, you have a capital gain and loss. And then airdrops and sort of like the staking and things like that, there's an argument to be made that it's passive income, which would actually be better for taxpayers because of self-employment tax stuff. But it's not clear if that's fine or not. It's definitely not the most conservative position. But at the same time, how much work are you doing if you're just receiving an airdrop that you didn't even know about? So again, this is just the beginning of the rabbit hole of how complicated crypto taxes get. But in one sense, airdrops could be reported as income, and then when you sell them, you have a capital gain and loss. But if you're doing that, make sure to be consistent and report all your airdrops then. Or if you're going to do it as zero cost basis, so when you receive it, you don't report income, but when you sell it as if you got it for free for zero cost basis. You pay the full gain, in other words. Make sure you do that consistently as well. And a lot of people get confused and they say, wait a minute, I got a fork, and so when I sell it, I don't have to pay. It shouldn't be zero cost basis because, Bitcoin Cash was worth $266 when I got it. So when I sold it for 300, I shouldn't have a gain of 300. And the answer is that's true if you report the Bitcoin Cash fork as income when you received it. There's no free lunch. You either have to report it as income when you get it, and then that's the cost basis when you sell it. Or if you don't report it as income, there's no double dipping and saying, oh, and then when I sell it, the cost basis is 266. No, that's not how it works. If you didn't report income when you got your fork, then it should be zero cost basis when you sell it so that the IRS gets their fair share. And this is one of the biggest misconceptions. And we spent many hours explaining this to lawyers, to even, surprisingly accountants. And basically the idea that you can keep in mind with crypto taxes is there's pretty much no free lunch. So a lot of the questions we get are like, wait a minute, if I did this in Binance, I don't have to pay any taxes on it, right? Or wait a minute, if I did margin trading, since I didn't technically take possession, I don't have to pay taxes, right? And the answer is pretty much always yes, you have to pay taxes, even though it was on Binance, or even though you did margin trading, which is a short sale. All right, just finishing up your list. Working for cryptocurrency, yeah, basically it's a Schedule C. It's like you're a self-employed person getting paid in crypto. But remember, you can offset your expenses. If you had to buy a laptop, if you had to buy a coding class to learn how to code in some language for that job or whatever it is, come talk to an accountant or talk to your own accountant. Come talk to an accountant at TokenTax. We can help you do this. You don't have to necessarily report all of the income with no expenses. So that's one big thing. If you're getting paid in crypto, remember, this is just like your own self-employment business. You probably have expenses to offset, and we can convert all this stuff to US dollar for you. And receiving it as a gift. Now that's complicated. A lot of people think, oh, when I receive it as a gift, I can use the cost basis when I received it. And that's not really true. You need to, otherwise, I mean, not to go too far down the rabbit hole on this, but when you receive it, you need to figure out what that person paid for it, and it inherits the cost basis. So if your sister gave you crypto and she bought one Bitcoin for 1,000, and when she gave it to you, it was worth 10,000, and then you sold it right away, you can't say, oh, when I received it, it was 10,000. When I sold it, I have no gain. No, you need to use her cost basis for it, because otherwise you can imagine when you give it away and you mark it up, that would cause a big problem. No one would ever pay the gain on it. But there are rules about gift exclusions, 15,000 per year per person. And if you're giving someone a gift, it's also different. And you need to, or if you're donating a lot of money to like a church or something, you can track the tax lots and figure out exactly which crypto you're giving away. There are different rules if you've had it for over a year versus under a year. The answer here is don't give away property that you've had for under a year if it, you don't get the full value versus something that you've had for a year that's appreciated. But yeah, again, gifts are quite complicated. So before you just go giving away crypto, definitely talk to an accountant or talk to someone. You can even come to Intercom and ask us a quick question, but you'll be glad you did it before you gave away the crypto, before you find out, oh, wow, the crypto I gave away that I bought for $10,000, it went down to $2,000. I gave it away. And now that $8,000 loss just disappears into the ether. And one last thing is, hey, a lot of people lost money investing in crypto or getting paid in crypto, but you can get half of that money or a lot of that money back by reporting your taxes, realizing the losses. So you can't just buy one Bitcoin for 10,000 and watch it just go all the way down to 3,500 and do nothing. You have to actually sell it, realize the loss, and then that capital loss helps you reduce your taxes and save money on your taxes. And you can even block your ordinary income as a radio host, as a mailman, as a software engineer, whatever. You can take a capital loss from investing in crypto and reduce your ordinary income from whatever your job is. So this is a critical thing. If you lost money in crypto, you can actually get some of the money back. And so it's just important that you have to realize the loss, as in you have to sell it. You can't just hold it. But yeah, hope that was a pretty useful list. But again, there are dozens more types of crypto events like SAFs and gas tokens or whatever. And all of them kind of have a different answer depending on how big of a player you are, how much influence you have. For forks, for example, if you're a miner and you have huge influence on whether a fork happens, well, that's probably a different situation than if you're just a guy who bought Bitcoin and had no idea a fork even happened until you logged in 6 months later to find whatever other crypto in your wallet, if you're lucky enough to have your wallet supported for that.
Great. So that was a pretty good run through.
Sorry for the monologue.
Hope you guys got to capture all that. If you didn't, this is available on replay or to view again or on the podcast app. And we're also going to have a recap on this episode posted later on. So I guess receiving crypto or gifting crypto as a gift, that's a bit of a tricky one, and cost basis is important there.
Yeah, exactly. I mean, when you get a gift, you need to know, or if you give someone a gift, tell them the cost basis, tell them what you paid for it so they can figure out their taxes. Or if someone gives you a gift, make sure they tell you what they paid for it. So many times, 3 friends have been trading crypto. Oh, most of the time we have missing cost basis on our site. It's people forgetting, oh, my brother gave me crypto. Oh, my friend gave me some Litecoin because he wanted to buy something on Binance, but he didn't have an account. If you do that one time, your data is going to look wrong. It's going to look like you sold more Litecoin than you ever bought. And then you need to know how much they paid for that Litecoin to get it right. And this goes back to the record keeping. If you're going to trade for other people on your account, keep really, really, really good records, because I promise you'll forget. in a year, and then it takes a lot of searching through clues and a lot of time to figure out, oh, wait a minute, yeah, that's from so and so who gave me whatever crypto. And in the end of the day, it's probably not a great idea to do it. It might be an awesome short-term opportunity, but try to keep your records and data as clean as possible, because you want to make it easy when you report this to the IRS. You don't want it to be a minefield of where's this? What's this because of? Because you can see all the major exchanges are sending 1099s to the IRS. There's no hiding in crypto, and as long as you're doing the right thing, paying your fair share, you don't have to be stressed. It's not like they're on the hunt for crypto people. Just pay your fair share and get your data tracked and reported properly.
Great. And next on here, we had short-term and long-term gains, which I'm pretty sure you covered a little bit earlier. And there's not much there.
Yeah,
But
long term
yeah,
is over 1 year. 1 year in the U.S. Common misconception: people think it's different amount of time, but once you've held something for 1 year, the taxes are dramatically lower. So that's sort of the reason. Going back to like in stocks, when you just open an E-Trade or a Ameritrade account, they automatically have you do FIFO when you sell. Let's say you bought 10 shares of Google and then you reinvested the dividends. So every dividend you got, you bought a little more Google. So let's say 10 years later, you have 20 shares of Google. When you go to sell 4 of them, if you haven't selected to do specific shares accounting, to do specific tax lots, it defaults you into FIFO. So a lot of people are like, oh, FIFO must be required. And the reason why it defaults you into FIFO is because long-term capital gains rates are so preferable to short-term capital gains rates. So if you're deciding between FIFO and LIFO, which are equally easy, they're going to default you into FIFO because the goal is you always want all your gains to eventually be long-term capital gains. If you do LIFO, you can imagine your last 3 purchases are within 1 year. So if you just sell a couple shares of Google, half of it's going to be short-term capital gain, half of it's going to be long-term capital gain. And that's, I think, the biggest reason why stock brokerages, et cetera, say FIFO is the default. And some people say it's more conservative. Well, look at 2018. Anyone who's using FIFO and only invested in 2018 actually has way lower taxes than someone using LIFO for 2018. So it's not always more conservative to use FIFO, to be clear. So but yeah, at the end of the day, what you want to be doing is tracking your tax lots in real time, making the decision before you trade which Bitcoin, which Ethereum, which tax lot you're going to sell of each crypto. That will pay for itself many, many, many times over. And please come talk to us if that's not clear to you about how to do this.
great. And thanks for clarifying that. Next is maybe a question that maybe somebody might have encountered, or something that's sort of a no-go when it comes to reporting. Obviously, do report if you're involved with crypto and do have these gains and losses.
Yeah.
But the next question is, what if somebody was new to the crypto space, say about a few years back, or a year, or like they missed a year of their of filing? What is a sort of a process of somebody to report sort of past history of crypto? Like, say somebody bought it early on and had no idea it was taxable, but now they're on this. They know about it being taxable events. Where would they go about filing, or correcting past years?
Yeah. Great question. And first, don't be nervous if you are in this situation and you didn't realize you had to pay crypto taxes. Now it's becoming a more mainstream topic. You're listening to a podcast about, you realize, oh wow, I owe tax returns. I need to amend my tax returns for the last year or the last couple of years. And the answer is just get ahead of this, and you can amend your return in TurboTax. It's pretty inexpensive. We do it for a couple $100 just as kind of a service for the community, because I know this really stresses people out. But let's say, if you made money in 2017, didn't report your crypto taxes because you didn't realize you had to, and then you lost money in 2018, what you really don't want to do is only report the loss in 2018, because that just looks really bad to the IRS. When you realize you haven't paid your taxes, there are inexpensive ways to do it. We'll help you amend your return so you can just do it on your own, or do it for you for, a couple $100, where just to pay for the CPA's time. And you can go back and amend as many returns as you need to. Now, if you have losses, you can only go back 3 years. So there is a little bit of a time constraint there where, hey, if you lost money in 2016, the clock is ticking to go back and claim that loss. But if you owe gains, like most people only had a few $100s in gains in previous years, and it's not that big of a deal to go back and amend your returns. People are intimidated by amending. In TurboTax, it probably will take you 30 minutes, and we're happy to walk you through how to do it. You go into your account, you pull up your return, you click amend return, you add a new capital gain and loss report of the crypto, and then you submit the amended return. It all flows through. It's really not that scary. And, I would just say get ahead of this before the IRS starts sending you a letter saying, hey, Coinbase told us that you had crypto sales in 2015, 2016, 2017, and we only heard from you for 2018 and 2017 or whatever. And, it's kind of just for peace of mind as well, because, these crypto exchanges are trying to do the right thing. They want to be regulated. They're not trying to fight with authorities and regulators and go, that's not a hill they want to die on. So you got to know they're going to report all the data to the IRS. So you already know what the IRS is going to know. So just amend your return. It's way simpler than it sounds. Trust me. And just get ahead of this, I would say.
Great. And good to know that there's amending available for not so much of a great hassle.
Yeah, if someone's trying to
be
charge
able to amend.
$1,000 for an amended return, there's no need to pay that.
So next up is something that people might be overwhelmed about, is how accurate does the reporting have to be? Earlier you mentioned you'll have to sort of fill in missing cost basis. So whereabouts should somebody be in regards to accuracy?
Yeah, great question. So, you want it to be as accurate as possible. At the end of the day, sometimes there are situations like, well, I lost access to my account on Binance, on HitBTC, whatever. We just have a void of data. So basically, the number one, you have to give your best effort. That's what the IRS wants, is like, hey, I hired someone to help me. I did my best to fill in the missing data. It's not perfect, but I got it as good as I could possibly get it. And you know what? If in the worst case scenario, they decide to audit you or take a closer look, they'll see that effort and we'll help you make it clear. But at the end of the day, yeah, you want it to be perfect. But if you have tens of thousands of trades over many years and missing data, of course, it's hard to make it perfect. Just some key rules of thumb here are, crypto to crypto data being missing crypto to crypto data is not as damaging as missing a trade from crypto to fiat, because long story short, if you're doing the prices correctly, which not all crypto tax software do, just as a heads up, but assuming that, hey, if I spend $10,000 of Ethereum to buy ZRX, when I go to sell that ZRX, the cost basis should be $10,000. Let's say I sell the ZRX for some other altcoin, and then I sell that altcoin for some other altcoin. As long as you have the trade that gets it back into US dollars, the middle trades should theoretically cancel each other out, as long as you've sold everything by the end of the year or whatever. Where you end up having issues there is like, oh, this happened over the course of several years. So it's a timing issue of when the gains happened. But bottom line here is crypto to fiat trades are really critical. Crypto to crypto trades are very important, but there are ways to make sure that it kind of all cancels out. If you can plan ahead and kind of sell to fiat or whatever before the end of the year, and then you can prove to the IRS, look, I'm missing this data, but here's the fiat I put in, here's the fiat I have at the end, and here's a snapshot of what's there. The more data you're missing, the more professional help you should probably get, or the more you should invest time trying to recreate that. But don't just rule of thumb, oh, I think the average is this. The average price of Bitcoin this month was whatever, and let me just put in a buy of Bitcoin for dollars. Like, if you don't understand cost basis and don't know what you're doing, don't try to do stuff like that, because you end up causing more problems for yourself than the benefit is worth. You need to be conservative. You need to have tools that say, all right, the minimum price of Bitcoin in this period was $300. So I know no matter what, I had to pay at least $300. And that way, if the IRS ever wants a closer look or wants to see where you got that purchase from, you can say, well, no matter what, I paid at least 300. So, if you want to look closer, I'll just end up owing you less money because I was as conservative as I could be. And that's exactly what you want the IRS to realize when they start to look closer at your data. And, so that's the key thing. Just try to be as conservative as possible, but fill in what you have. Um, and, obviously some people will never be able to have accurate data. If you had Quadriga, if you had Liqui, if you didn't get your data off, we're about to go through this again for people in 2018. So, try to keep your data as up to date as possible.
Great, and I hope the viewers got to learn a little bit about taxable events in crypto and some of the common misconceptions and common practices for U.S. taxpayers. So, Zach, is there any latest news in regards to crypto tax regulation here in the U.S.?
I mean, there's been some bills floated in the US Congress. So basically, none of them have really had a great chance to pass, but sort of bills that simplify the taxation and give some common sense guidance. Maybe like, hey, if you and put your money into Binance exchange that doesn't, or some exchange now that doesn't have a fiat on ramp or a way to cash out to fiat like dollars or euros, and you do your trading there, maybe you shouldn't be taxed until you pull your crypto out of that exchange. I mean, I think that would be a great step in the right direction because it's insane how people put money into Binance in 2017, whatever, turned it into a US dollar value, enormous gain, but they never even had a way to get that out into dollars unless they transferred it out of Binance. But basically, you see some common sense legislation and rules getting proposed, but none of them are being taken super seriously. But it's a great step in the right direction. And, this shutdown just happened for over a day. So all the IRS audits, everything they were doing got completely paused. So all the work probably backed up. And so who knows if they were going to do guidance on crypto before April 15th, maybe now they're not going to be able to do it. I'm still surprised they haven't given any more guidance over the past couple of years since we've been doing this. But here's to hoping some new clarifications come out as soon as possible, because no one likes to have to try to figure out the rules and and follow them. It'd be just amazing to get more dialogue with the IRS on what they want to see, how they want things treated, so that we can all do it consistently and just make everyone's life easier in the space.
Great. So what are some of the
Yeah.
what are some of the ways that either you yourself or individuals at TokenTax keep up with the latest regulation, either both here in the U.S. and everything else going on in the world?
Yeah, great question. I mean, as with everything in crypto, most of the news goes pretty viral on Twitter right away. And we have contacts. We're in accounting groups or whatever that are sort of writing these professional letters to the IRS. So there are different channels there where we can kind of find out, hey, what's the progress on this? What's the enforcement on this? And so basically through professional networks, I would say for just individuals, try to follow TokenTax on Twitter, follow some of these guys on Twitter who are always breaking tax news. But at the end of the day, there are so many things to master in life that it's kind of like, unless you're doing this as a job, there's going to be so much random information about crypto taxes. A lot of people saw those bills proposed in Congress and thought, wow, that's new rule. And then the more you read about it, the more you realize, well, and it was during pretty much like an empty session. They never really had a vote. It wasn't taken that seriously. But if you're not in the industry, it's really hard to sort through what's major news and what's not too important. So I guess, talk to an expert, follow our Twitter, come talk to us if you hear something and you're not clear. We're pretty much always there. As I said, on Intercom, on the bottom right of the tokentax.co website, you can always just chat. Hey, I heard this tax breakthrough in Australia, or these new rules in Australia or UK. And we'll be like, oh yeah, that is new because of this. Or, oh yeah, that was 7 months ago, but now it's getting rerun because someone else just realized it or whatever. Yeah, I wish there was a better answer there. That's a great question. We'll try to do a better job of curating the important news for tax junkies out there, crypto tax junkies. I know we have a lot of those as customers.
Great, and thank you all for watching this live. I think this pretty much sums up or wraps up this episode. And what we covered today might not be might not be the same things that will be required a year from now or 2 years from now. So it is important to follow up with your own financial professional to see what you should do in your own scenario and what the latest regulations are. So for all of you that are watching this live, thank you so much for joining us. I see we have a Coin Gamma in the chat and Embu Gaming. Thank you guys for joining us on this episode. And I'll link down TokenTax and Zac. I'll link down his info down below if you guys would like to learn more about him and his company. And yeah, we'll see you guys on the next episode. We'll have a special type of episode OC Live next week. We're gonna have Mike Dudas of The Block, which is a publication on crypto news, and he's gonna be interviewed by OST's CEO Jason Goldberg. So very exciting episode next week. Be sure to stay tuned for that. Other than that, Zac, thank you so much for joining us on OC Live.
Oh, thank you so much for having me, and look forward to hearing Mike Dudas's episode next week. He's great. We know him from here in New York.
Great, and
Thank you so much for having me.
we'll see you guys next time.